And we are live with Thomas and Shauna.
Oh, us?
Yes, you.
Yay.
Again?
We're live with
Thank
you.
you.
It's weird that you keep letting us on the show. I appreciate it.
We're wondering when he's going to kick us off.
I'll take it.
Paradigm Shift Financial is your organization.
It's true.
You guys have a really unique way of looking at things. One of the things you've been doing is educating me on some of the things. I've known there's a few wicked things going. I think most people know Wall Street is trying to steal their money.
Yes.
I think most people realize that.
They just don't know that there's alternatives.
They don't know there's alternatives is super important, but
Yeah.
they also don't know where to look to find it. They're like, oh yeah, Wall Street's stealing money from people, but not me.
Right.
Right.
I stay away from Wall Street.
I just work with that Edward Jones guy. That's, a giant Wall Street company.
Yeah, they don't. But I'm not in. I'm not in with Wall Street. I never even go to New York.
Yeah.
But when we say,
It's weird how that works.
it's a funny thing. So I personally have looked into different mutual funds and things like that, which is kind of the thing we're going to talk about. The diversification will come in there, I'm sure. People buy mutual funds because they say, well, listen, I don't want to have to pick 100 different stocks, or hey, I only have $20,000 to initially invest, so
Yeah.
I want to be diverse. I want someone who knows more than me to be looking after it. I want there to be a track record. I want all these things. I'll just invest in the mutual fund. Now, some people do that through a broker. Some people do it online on their own.
Yep.
But they may, if they don't dig to the second or third layer, they may think that it's not costing them anything.
Yeah.
They may think that they're literally getting the returns from that mutual fund without there being a cost.
Well,
associated.
most mutual funds are 501c3 charities. That's why. So they, don't have to charge
There's
Is
anything.
that
fund,
true?
There's no
No.
fund manager.
No, it's not. I just lied on TV. But I admitted it. So that makes it okay.
Immediately, yes.
Right.
That's false information.
Well, the NFL is a 501c3, I believe, or
Oh, yeah.
some sort of nonprofit.
Right.
So I almost believed you for a second. I did.
I caught that.
Yeah. Because
Psych.
now, for most people, if you asked, I think, well, how much should you be paying in fees? Obviously, it's not free. They're not a charity. That's what you're saying. Hey, it's got to cost something, right? It's got to cost something. But how much is okay? How much is too much? At what point are you being taken advantage of when it comes to fees for investments? And specifically, this is the big question that we're going to answer today is, are you getting what you think you're getting?
Right.
It's one thing to have a good intention. And a lot of those intentions of people who are buying mutual funds is, well, I want to buy and I want to hold because I know I need to stay in the market if I want to ultimately accrue the most money. I have to stay invested because I can't pick the right days, and if I'm out of the market, I'll miss the biggest up days, and those account for a lot of the gains you're going to make. So even if someone knows that and has listened to this show and has watched you guys come on here and speak about these things, and they go, you know what, I believe them, that sounds correct, let me go put my money in XYZ mutual fund. Are they actually getting what they want? So those are the two big things we're going to cover today.
Yeah. Well, and the whole idea of, the fee conversation, right? Everybody's really focused on the fee conversation. It's important. It really is. But it's all relative to what you're receiving as benefit, right? What's the return for the fee that you're getting or the fee that you're paying?
It's an investment.
Right. And I think the biggest problem is the lack of transparency in the fee space. Like if somebody looks at a fund and sees that there's 2% fee and they're paying their person 1% and they consciously make a decision that they're fine paying that, that's different than only thinking they're paying their person and the mutual fund's free.
Mm-hmm.
So that's more of where we're at with this conversation is having people get really clear on what they're actually paying
Right.
so that they can be empowered to then decide if they want to pay that or not.
And I do want to say right off the bat, too, early on in the segment, that you guys do those audits for people for free. So if someone has investments, they can contact you. You will audit their financials, tell them exactly what fees they're paying. There's a lot more to it than that.
Well, now that you said we're doing it for free, I guess we're doing it for free.
See, adding value right here.
But only if you come through the show.
Yes, you have to mention the show.
Exactly.
Have to
Right.
mention the show. But what you'll be able to do in that, and we went through this last time you were here, we went through an MRI, as you call it, of someone's investments. And we have a couple of examples today that we'll look at as well. So you can kind of see, well, what happens when you start digging a little deeper into these things? What are you finding? What's in there? And a lot of times it's people not getting what they thought they were getting from just an investment standpoint. And also paying way more than they thought they were paying. And those are two things I think most people who are not like daily looking at, you know, their 401k and stuff, they're just thinking, hey, I have a certain amount going in there every month, it's drafting out of my account, I'm just trying to save up money and for retirement. They're not looking at it very often. I think they'd be pretty disappointed to find out those two things are mostly true.
Well, and to be fair, every single client receives a prospectus on every fund that they're in, but the prospectus is like 100 pages long. You can't expect every client to read every single prospectus that's going to outline all of the fees for them. Like, the advisor should be transparent in the fees.
And the prospectus is like legalese. It's like, wherein, therefore, out mentioned.
Yeah,
like,
you can't decipher that.
could they write it in English, not the
Shakespearean
It's like
legalese.
the King James version of the Bible. Why hast thou forsaken me?
Sign here.
Well, I love the disclosures that you get. If you have any investments, you get these disclosures every once in a while. Something changes or a policy changes or whatever, and then you get this thick thing in the mail that says, here's the new shtick. We're not telling you which parts have changed, just here's the new manual.
And you should see how many times those things get sent out for people that are in active funds.
Yeah.
Because they're always changing.
Yeah. Well, let's talk about that. So you have a couple examples that you brought in here today. I'm going to actually pull them up on the screen.
Well, I think one of the really important things to just very briefly go into as you're pulling this up is that the biggest thing that this will illustrate for people is which investment philosophy they believe in. Because there's only two possible investment philosophies. You either believe markets are efficient or you believe that they're inefficient. And you know, for the sake of time, we're not going to go super deep into that, but basically the idea is if you believe markets are efficient, then you believe that it's not possible to consistently and accurately beat the market. So then your alternative to trying to do that would be investing long term. So a lot of people have innately that mindset of markets are efficient, like you were saying, right? But they don't realize that that's what they actually believe. So then when we hone in on the fact that they believe that markets are efficient, and then they see what their funds are actually doing, it gives them a very powerful space to look at it and go, are the funds that I'm investing in, and are the people that I'm investing with of the same philosophy as me? Because if you have someone that you're working with that doesn't even have the same investment philosophy, how can you expect that to work?
So you're basically saying either you're investing in the markets or you're buying CDs. You're like doing a CD ladder, like one way or the other. Either you believe the market is efficient, right?
Well, if you don't believe,
or you do that.
The other side of it, right? If you don't believe it's efficient, you'd still invest in the market, but you'd never invest long term. Because if it's inefficient, you're not going to get quality returns. If it's inefficient, what you need to be doing is looking at the individual stocks and individual markets and trying to figure out, is this one underpriced, is this one overpriced, and then doing short-term transactions. Because if the market's inefficient, why wouldn't you try to capitalize on those inefficiencies? And if you believe that, then you should be able to do it predictably, consistently, and accurately.
Which no one can do.
Most people would. There are people that will say they can, and then they can until they can.
Right.
Right. You know, just blind statistic luck.
They're out there teaching other people instead of just getting rich themselves. It's weird how that works.
I have a secret for trading stocks. I'll share it with you for $9.95.
I get all these Facebook ads that I tag her in, and the most recent one was the one stock retirement plan. How to just invest in this one stock that'll take you out. And I'm like, I'm sure out of 20,000 available stocks just in the United States, this one is got to have the answer. And he somehow has to have the answer ahead of everybody else. And when he teaches everybody else, it has to still be an opportunity. Weird how that works. All right.
Is it Apple?
Don't think the secret's That's our alter ego.
I think one of the points to be made here is that a lot of our clients will hold 10 funds for 10, 20 years, mutual funds, and they think that they're passively investing. But they don't know that the funds are actively managed.
Let's dive into that.
Yeah,
let's pull this up, Carrie, real quick. So this is a Smarter San Diego portfolio here, as you can see.
Very robust and diverse.
Prepared by Thomas and Shauna. And you can see the name. We got market value, market cap. What's PTB?
Price to book.
Price to book, okay.
It's basically how you determine if it's a value company. So there's this idea in academics that the return on your capital, the return on your investment, should equal the cost of the capital.
Okay.
And so we use price to book to measure basically how risky or how struggling that company is. And it's been indicated through time that companies that are struggling, the markets that are struggling, actually have a higher return than growth companies.
Interesting.
Yeah, it's weird.
So strange.
We can go into deeper detail after we walk into that of why you don't find that in investing. It's actually very simple why you wouldn't find that, and it produces higher returns consistently than growth companies.
Wow.
Yeah.
That's crazy.
Yeah.
That's amazing. So you have, and one of the things on here too, I mean, expense ratio, obviously something to look at. This we're talking about costs.
Yeah.
So on the far right here, we're looking at expense ratio.
Well, yeah, the three most important columns of this analysis that we walk through with people is the holdings, the fund turnover, and the expense ratio.
And the holdings is the number of stocks that they are, or securities
Stocks
that
and
they own?
bonds, yeah.
Mhm.
Yeah. And so a lot of people will look at that and think that they're diversified, but they don't realize that those funds hold the same things. So I might have that top one might say 200 or 378 and the bottom one 175, but they might hold the same thing, so I'm just doubling down on the same investments. So I think I'm diversified, but I just own the same stuff.
What's this one here? This 11.5, is this a typo for the expense ratio on this
No,
one?
it's not. Here's the best part. So this isn't a particular client's account. We removed the name for, because we don't want to get sued. And we promise confidentiality to all of our clients as far as we'll never tell people who you are or any of your information. But, when it's crazy like this, we'll show it without your name. So that expense ratio, this client was under the impression, they believed they were only paying their advisor 1%, and that was the only fee that existed in their portfolio. That's what they told us. That's what they believed. And they said, we disclose all of our fees. And they said, well, you're coming in a little bit more expensive than my current advisor. I was, how so? She goes, well, we're only paying 1%. And I said, you want to be sure about that? Because she thought that the funds underneath were free. And when we did this analysis, it boggled our minds. We've never seen an expense ratio that high. But that's I had to double check it.
That's crazy. I mean, insane.
We thought our system broke, so we had to double and triple check that. That's a closed-end mutual fund that invests in limited partnerships that has that expense ratio of almost 12%. It's costing you 12% to be in it. And this particular client had over $60,000 in that one fund. Oh no, wait, actually, the one right
63,000.
yeah.
Wow. And you're paying 11.5%.
Right.
That is absolutely crazy.
And then no wonder their returns aren't coming in a way that's actually having you earn, create wealth.
That is bonkers. And even some of these ones, 175. Now this is just the fund expense ratio, right? This is not what you might be paying the advisor.
Yeah, she was paying the advisor 1%. So right there, that fund actually costs, and that's just the expense ratio. There's other fees that go into this besides the expense ratio, but this is the ongoing fee. So this particular fund's costing this person 2.75. The one right below it's 2.29. And then some of them are A shares. So that one that's at the very top says A share.
Yeah.
A shares have an upfront fee that, depending on the amount in the account, is usually 5.75% upfront when you put money into the account.
5.75%.
Yeah.
So every
Upfront fee.
time you buy into it, you pay that.
Yeah. So imagine, just for simple math, imagine it was 6%, right? So the person puts $100,000 in the account, and they immediately only have $94,000.
Yeah.
Because the fee was 6% in that example.
Holy smokes.
Then it's 1.75 ongoing, and then it's 1% for the advisor.
So in case you're wondering, how does Wall Street get rich without you realizing that they're putting their hands in your pocket? Okay, because that's what's happening.
Yeah.
This Wall Street's doing this number.
Just shave a little off the top and
This is a
pocket.
skim. It's like we were just talking about the movie Casino. It's a skim.
Yeah.
I mean, that's kind of what it is. And now 11%, that's completely egregious. I mean, I can't imagine how they justify that. But in my mind, it seems like this is the kind of thing that, and I don't want to say, I don't know who their advisor was specifically, but it seems like the kind of thing that's like shady, that there's a few of these just floating around out there, and the certain types of advisors would take advantage and put people in something like this when they know that they wouldn't know any better.
Yep.
Right. And this particular account, if you look at all of the fund turnovers, that's how much the fund manager is trading within the fund.
Okay, so let's talk about that, because I think for like a lot of people are expecting when they buy a mutual fund that they're invested in the market. Does a mutual fund own certain stocks, and that's it?
Yep.
There's nothing else to it. But really, what's happening is they're paying this fee so that the management team can actually get in and out of stocks on a regular basis. Isn't that right?
Yeah.
Right, exactly.
Well, and here's what's fun. Like, a lot of people, when you have that philosophy conversation, will agree. They'll say they think markets are efficient, right? And then we look at what their advisors are doing and what the funds are doing. So this particular client's advisor had them buying and selling. They did 100, just the advisor did 130 transactions last year. So into mutual funds, out of mutual funds, into stocks, out of stocks, into limited partnerships, out of limited partnerships, 130 last year. Okay?
Their advisor did.
Their advisor did.
So on top of the turnover in the fund, she was selling and buying new funds also.
And just to explain so that people watching this understand what a fund turnover, take that second one that says 197, almost 200. With that, it's a percentage. So what that means is that fund has almost a 200% turnover rate. Another way to explain that is if that fund owned 10 stocks in January, by December, it would have sold those 10 stocks and got 10 new stocks twice.
So they're basically trading the markets.
Mm-hmm.
But the understanding for the investor a lot of times is probably not that.
Mm-hmm.
They think that they're in the market.
Yep.
So this is why there's so many different mutual funds, and they all perform so differently in comparison to the market.
Oh, yeah.
And every once in a while, one beats the market, and then money floods in like crazy.
Every once in a while.
Those Morningstar five-star fund reviews.
Yes.
Those, weirdly, when you put money into them, they're not 5-star anymore. Man, if you only could know in advance which ones were going to be 5 stars.
5 stars doing so well, let's buy it at the top.
So there is, though, a tool, right?
On a side note, did we just get trolled by someone for McCain? That's sweet.
Is that a trolling? Is that effectively a trolling?
I think so. It has nothing to do with this.
Well, I only consider you a troll, Stephen, if you meant something bad. Which I don't think you did. If you're not being a jerk, I'm not going to consider you a troll. So
We might have to talk about that.
yeah, we may have to recalibrate the definition. So for people who want to buy and hold and be in the market, like this is what you guys teach. And I understand that you have some live events coming up, and you have webinars that you do on a regular basis, and one-on-one coaching for people to understand. Really, you believe the same thing I do. To answer your question, why do I keep having you back? Because we both believe the same thing.
Yeah.
People deserve to know the truth.
Yep.
You deserve to know the truth about what you're paying, what it's costing you, what your risk to reward situation is, which is another big one, which we can go into in great detail, and probably will on another show, because the risk reward is what it's all about. I mean, that is really everything. It makes sense. Like, okay, a CD, you get 1.9% or whatever it is. You have no risk if you're under 250 grand. There you go.
Yeah.
So you have very little risk, very little reward. Okay, that makes sense at least, right?
Yep.
But if you want to have big returns, if you want to grow your wealth, you may have to take a little more risk. But that doesn't mean that you have to be flapping in the wind at 11.57%.
That is the highest we've ever seen it. And it's criminal.
It is criminal. I mean, I'm looking at 175 on the very first one that we looked at there, which also there's $60,000 some dollars in. That's also very high.
Yep.
Very high. There are some of them on here that are more in line with reality, or what I would say decent expense ratios, 0.12, 0.17, 0.07. Those, there you go.
Yeah.
That's great.
Yep.
But when you're at 1.75, 1.2, I mean, they really better have some special sauce,
Yeah.
right?
Yeah.
What is worth that?
Well, but here's again where we talk about why it's the fee. It's important to be transparent about the fee, but then why the fee isn't always the end all be all. Because if, again, going back to the philosophy, right? If you believe markets are efficient, right? And then you find a low cost index fund or a low cost ETF, and then you see the turnover rate, and the turnover rate's 50%, well, are they following the philosophy? Even though it's a low fee, are they following the philosophy that you can't time the market if they're turning over half the portfolio in a year?
That's a very good point. Are there any funds that don't do that? Or they're just lower versus, like some of these I see the turnover rate is 10%, for example, on that first one, that Class A.
Shameless plug. The ones that we put in place have, like, the highest is 5% turnover and the lowest is 1.
Really?
Yeah.
So you're looking for very low turnover.
Yeah.
Yep.
Because if you're doing low turnover, then you're actually following the market and you're actually investing in the market without trying to time it or pick individual securities. And then what's happening is the reason there is a turnover at all in those is because they're rebalancing. They're buying low and they're selling high. So you want some, like if it said 0 turnover, that's a problem because it means it's never capitalizing on when things are selling at a discount or when things are trading at a discount or trading at a premium. So you want some turnover for the purpose of buying low, selling high. But when you have 50%, 70%, 180% turnovers, there's no longer a buy low, sell high. It's just
That's what I see. I see people freaking out in like a room, like, now we gotta sell it. Oh God, now we gotta buy it back.
Yeah.
It's now we have another example on here too, right?
There's a meme that I have because I speak in memes. It's guys in a stock, like a stockbroker office, and one of the guys looks out the window and he goes, snow's falling, and the guy behind him goes, sell snow. They go, sell.
That's great. This on this the second example here that we have, which again is made for Smarter San Diego by Thomas and Shauna, and same. This is basically the same format that we were just looking at. This is just a different investment group. And tell us what some of the things that we're looking for here. I know we've got this high turnover guy right here.
Yeah, and that's an ETF. So someone would buy that and usually think, oh, well, the expense ratio is so low, it must be tracking the market. It must be it must be a passive investment strategy.
Wow.
And then you look at it and it's like, nope, it's the opposite of passive.
And these are just facts, right? So like we're just showing you the facts here of these particular holdings that correlate to these different investments. That's an iShares bond ETF.
Yep.
And there's a lot of iShares stuff out there, and some of it is very highly rated. And based on that brand, a lot of people would just say, yeah, sure. Oh, 0.05, cool. Yeah, I want some bonds. Give me that ETF.
Yep.
But now you're in and out of bonds that much.
Right.
How? How do you even trade bonds that often? Like, do they trade that often?
You can. There's a secondary market for them, which is where that happens.
I mean, that is wild. I would think the idea with bonds is that you're really buying and holding. I mean, that's got to be the concept with that.
Well, Shauna will tell you the concept with bonds right now.
What?
Well,
Paper
I mean,
shredder.
short-term, high-quality bonds is what you want in your portfolio. Not long-term bonds, because long-term bonds have a very high volatility and high standard deviation and a low return. So we never put that in the portfolio.
Okay.
Yeah, so bonds exist. Short-term, well, she says short-term high-quality bonds, because bonds exist in a portfolio to allow you to generate quick capital to buy when the markets are down. That's the rebalancing aspect.
Yeah.
Gotcha.
If you don't have any bonds in the portfolio, you're not, so backstep a second here. Bonds have like a zero correlation to movements of stocks if you're looking at a correlation matrix. So you always want to have some type of percentage of bonds in the portfolio so you can rebalance. Does that make sense?
Yeah, so when you're getting paid from your bonds, right, which happens quarterly or monthly depending upon the bond, right? Something like that. And the money comes in, that allows you to be able to buy or build cash up to buy stocks when they're down.
Or even the bonds themselves.
Yeah.
Right. If it's a 1 month bond, I can sell it relatively. Like again, remember the secondary market. So I can sell a bond. If it's short term, high quality, it's pretty much always going to be worth whatever I paid for it. But long term bonds, why we don't have those in the portfolio, is because they are insanely risky. They have this almost, when she talks about standard deviation, we're talking about, actually, we had a realtor friend that explained it perfectly.
Yeah.
Standard deviation is the size of the wave that you're taking. So the higher the standard deviation, the bigger the
Bigger the
wave.
wave.
Like, do you want a Maverick or do you want like a little chills, right? and bonds have the same, almost the same standard deviation as the S&P 500, long-term bonds.
Yeah.
Almost the same standard deviation. So they're almost the same level of risk, but they have a capped return because bonds are only going to pay you a coupon.
That's right.
But that doesn't mean the price of the bond can go down. Like if you paid $1,000 for it, there's not necessarily you're getting your $1,000 back at the end of a 30-year bond.
Right. It depends on what you paid for it, right?
Well, it depends on what's going on in the market. Yeah.
Or what's going on in the market.
Yeah.
Well, again, that's the whole point, right? So bonds exist to sell. They exist to provide short-term, like little boosts of cash, and to sell to buy the stocks when they're down. So if I have long-term bonds and they're volatile and the stock market's down and the value of my long-term bond is also down, I can't rebalance now. I can't sell it because then I'm selling a loss, and that doesn't work out for rebalancing.
It's actually genius because that's where when money flows out of stocks, it goes into those short-term bonds.
Bingo.
Typically. So if you're already holding them, then that should be a good thing for you if you're going to sell them to buy stocks.
Bingo.
Yep.
It's genius.
Thank you. We didn't come up with it, but we sure believe it.
It's brilliant.
Nobel Prize winning economists came up with it. We just look at that and go, they won a prize for it. It makes sense. Probably just teach people.
Sell high, buy low. Makes sense.
Yeah, no, that's so genius because I think a lot of people believe they need to hold cash
Yeah.
in order for those situations.
Yeah.
Or dividend type stocks,
Right.
so that they can have that cash coming in to hopefully buy if the market goes poorly.
Yeah.
But that is actually genius because then you could potentially sell those bonds for a premium too.
Mm-hmm.
You may make a little money on that trade and get the cash.
Yep. And we have history. One of the presentations we do, we actually look at that throughout segments in history, and you can see instances where the stock market or the portfolio was down 13%, but short-term high-quality bonds were up 3%. Okay, well, I just made 3%. I can sell that, buy the thing that's at a discount, and the next year it turns around, and I recapture my loss and then some because I rebalanced. But you look at the same time frame, and maybe long-term bonds were down 7. Well, if I was down 13 and down 7, not only did I lose the opportunity for rebalancing, but I also I extended my loss and had more. So it's why you'll never see long-term bonds in a academically designed portfolio. They just have no place in them.
Wow. And there it is, mic drop on incredible. Wow, this is just insane knowledge we're dropping it, making you smarter than everyone else. Here's 2 things you need to do. Favor for me, share this video, make your friends smarter than everyone else.
That's also a favor for us.
Yes, it is. Favor for yourself, if you have investments, you can't tell me exactly what they're costing you. Get the MRI. Get the free investment audit for people who are watching Smarter San Diego. See, that's why you always ask for forgiveness instead of permission, folks. The free investment audit is extremely valuable. You can find out exactly how much Wall Street is stealing from you, okay, without you knowing it. Find out how much your funds are costing you, front end, back end, the whole enchilada, by simply following the link that's attached to this video. It's not attached right now, but it will be in short order. If you follow that link, you'll be able to get that free MRI/investment audit. Thank you guys so much for coming today. Really appreciate your wisdom. You're always educating me.
Thanks for having us.
So profoundly. I thought I knew so much and humbled again.
I will say, if you keep giving away our shit for free, we may not come back.
That's a perfect way to end it right there, Carrie.